Good morning, everyone here in the US, and good afternoon to you in Europe. My name is Andres Portilla. I'm Managing Director and Head of Regulatory Affairs with the IIF. It's a pleasure for me today to welcome you to this regulatory discussion of the IIF European Conference. As Tim just noted earlier, you will be able to ask questions. You need just to type your questions at the bottom of the screen. I will be getting those questions and passing them on to our panelists. Let me also remind you that this meeting is on the record. There are journalists that are watching this as we speak. The focus of today's session and of this panel is to discuss the regulatory response to the COVID-19 crisis. For that, I have invited a great set of panelists. So please join me in welcoming first John Berrigan, Director General of DG FISMA at the European Commission, Veronique Ormezzano, who's Head of Group Prudential Affairs at BNP Paribas, and Jose Maria Roldan, who is Chairman and Chief Executive Officer of the Spanish Banking Association. Before we go into the questions, let me just make some very brief remarks to set the stage. Well, I think the first thing to comment here, and as we just heard in the comments from Andrea and Ria earlier today, this is a very special type of crisis. It's very different from the one that we experienced 12 years ago in 2008. The main difference is that this is a health crisis that unfortunately is also turning into an economic crisis. It is not yet a financial crisis, and we certainly hope it doesn't turn into one. But similarly to the past crisis, this one has resulted also in a very quick and rapid regulatory response. There has been unprecedented level of action by policymakers around the world to respond to the set of circumstances that are affecting the global economy. You have seen, however, that the main characteristic of those measures have been to provide flexibility. Flexibility certainly to the financial sector in order for banks and other institutions to be able to continue lending to the economy and to continue supporting their clients. We've seen a range of measures. Some of them are directly aimed at providing lending and credit support. We've seen loan guarantee schemes. We've been encouragement of usage of capital and liquidity buffers. We've seen policymakers reducing countercyclical capital buffers. We've seen a lot of funding and liquidity support, which has been certainly fundamental for markets to continue to operate. We've seen a number of measures directly aimed at allowing markets to continue functioning. We've seen many measures that reduce the operational demands on banks that certainly allow them to continue with their business and operational resilience plans. And then we've seen the postponement of certain regulatory measures. We have seen the delay in the implementation of a number of regulations, including Basel III, non-centrally clear margin requirements, the revised GSIB framework, for example. What I've seen is it has been very rapid, but also has been very consistent. We've seen regulators taking very similar measures across the world, in the US, in Europe, and in Asia. So in this panel, we're aiming to discuss that regulatory response, assess how effective it has been so far, what are the medium-term implications of these measures, but also whether there are longer-term implications for the regulation of financial services, certainly in Europe, but around the world. So to begin this discussion, let me ask John to tell us from the perspective of the European Commission, what has been the response? What is the current thinking of the Commission as to where policy needs to go? And certainly, if you could tell us a little bit about the quick fix package that has been presented and then now Parliament is discussing. I've been reading the press with some initial commentary from some of the parliamentarians. So, John, floor is yours, and tell us about the European Commission's approach to regulation in the COVID-19 era.
Well, thank you, Andres, and good morning and good afternoon to everybody. As you said, and I think as Andrea probably said before us, the name of the game in this acute phase of the crisis has been about getting liquidity into the real economy, and the banks, of course, particularly in Europe, have a huge role to play in injecting liquidity, either from their own balance sheet or from official balance sheets into the real economy. And so what we've been doing in terms of official regulatory response has been facilitating that process. Now, we in the Commission did released a package at the end of April which did two things. One, there was what is called an interpretive communication, which essentially just clarified a whole range of advice that has been given by the supervisors and the supervisory authorities around using the existing flexibility within the legislation. And that particularly relates to how you use accounting frameworks, so how you measure expected losses, and also how you classify loans as performing and non-performing. There is quite a lot of flexibility in the framework. We simply wanted to make sure that everybody understood that flexibility and that all supervisors and banks were using the flexibility consistently. So the communication just clarified all that, because there had been quite a number of statements from different sources, and we decided to bring it all together and just put it out there. So step one was to sort of use the existing flexibility. We then have gone a little bit further with the quick fix. And this is the second part of the package on 28th of April, was to put a legislative proposal on the table, which will make targeted changes to the capital requirements regulation, again with the objective of facilitating bank lending to the economy. There were essentially five main elements to this. We again worked on the accounting procedures, so we wanted to adapt and extend the transitional period for mitigating the impact of IFRS 9 provisions on regulatory capital, and that was to counter the kind of possible sudden increase in provisions in the context of the pandemic. We are proposing to postpone the date of application of the leverage ratio buffer requirement, and that's part of the final elements of Basel III. We introduced, in the context of COVID-19, a more favourable treatment of publicly guaranteed loans in the context of the backstop rule for non-performing loans. We eased the conditions for excluding central bank reserves from the leverage ratio exposure measure. And then we advanced the date of application for a number of factors, SME factors, the new infrastructure supporting factor. And also we facilitated a little bit and enhanced a better treatment, for a more preferential treatment, let's say, for loans backed by pensions or salaries. And also we brought forward more favourable treatment for software assets. So this was a set of measures which we think will make it easier again for banks to lend into the real economy. Now, the reason we put forward this proposal and not a bigger proposal was we kind of ran our proposals through a set of filters. And the filters were essentially three. One, they should be COVID-19 related. So it should be clear that they are a response to the pandemic and they're not something else that may have been there already, or it may be a more structural discussion around the legislation. So it has to be targeted very much on COVID-related requirements. The second was that whatever we do, we can deliver quickly. So once we change the legislation, it has pretty quick effect, because there's no point in arriving with things late. We need to do them now. And in the same vein of getting things done quickly, we had a third filter, which was to make sure that anything we proposed would already have a broad consensus among the member states and the parliament. So they would not prove controversial in the legislative process. Because again, we did not want that a package could be slowed down or even stopped by one element which proved controversial. So we put forward this proposal. I have to say, based on our first negotiations with the member states and with the parliament, we kind of got it right. I mean, this is not brilliant judgment. We prepared it in advance, so we knew pretty much what would be acceptable or not. So we think our proposal is pretty centred and has a very good chance of getting through quickly. Both the Parliament and the Member States have brought forward some additional ideas. We will have to see how much consensus they get across the piece. Again, we would argue that anything which is going to be slow or controversial, probably, however good it might be, defeats the purpose of the whole package, which is to get there quickly. Because, as we may turn to later, there are kind of two phases in this crisis. There's this acute phase, which is liquidity phase, and it's going to then be followed by a repair and recovery phase as we gradually come out of confinement. We want this phase, these measures to take effect in this phase. So it's no good that they come later. So we want a quick fix in the true word. It has to be a fix and it has to be quick. Maybe I'll stop there.
Thank you, John. If I may immediately come back to you on one of the issues that you just mentioned. I've been reading that some of the comments from parliamentarians are aimed at ensuring that the flexibility is directly used in lending, and that they would like to see additional measures in the package that ensure that. What is your thinking about ways to ensure that the flexibility is directly used on lending functions?
I mean, I can understand what they're asking for, because what we're, as I said, the name of the game is to use the banks to inject liquidity. We do not want the liquidity to get somehow blocked in the banking system. I'm not sure it's such a huge problem per se. I mean, one thing I think in my discussion with banks is that they understand that the counterfactual of banks not lending is a deeper recession, more permanent damage to the economy, right, and bigger problems for them down the line. So I think there isn't really this powerful incentive for banks not to lend or to conserve the capital. So I understand their concerns, but I'm not sure that they're as big as they might seem, because the banks themselves understand that if they don't lend, the counterfactual is even worse.
Absolutely.
So it's a difficult position to be in, but I'm afraid that's the logical.
Right. Jose Maria, let me go next to you. Spain, unfortunately, has been one of the countries most affected by the COVID-19 virus. I'd like to ask you for your overall reaction and response to what European policymakers have done. Has that response, that regulatory and policy response, been enough? Has it been swift enough, comprehensive enough? I remember many years ago, you were one of the first, if not the first, to use the term tsunami of regulation after the crisis. It might be that there is a tsunami of flexibility coming to the banking sector. So, Jose Maria, your reactions to that?
No, absolutely right. I think that we can say, without being saying something positive about regulators, Sean. It's hard. It's really hard for us, but we have to accept that on this occasion, I mean, they came out, in a fast, consistent manner that admired me, because it's not easy in these circumstances to come out. So on the side of supervisors, central banks, regulators like the European Commission, in the part of financial regulation, I think that their reaction was extremely fast. It was in line with the macroprudential philosophy and the counter-cyclical philosophy that was in the regulation. So it was, they are not just acting inconsistently. On the contrary, they are using what was devised there to be used, but they have done it in a very fast way. And I think it was very relevant. You were mentioning that, Sean. I think that this time is different. It's really different. Carmen Reichardt was saying the other day, this time is different, and I really mean it. On this occasion, the typical reaction of a supervisor or a bank manager in these times of stress is, try to control risk taking, try to fortify your balance sheet or to fortify the banks you are supervising. In this occasion, this would have been terrible in terms of the impact. So it was good that on this occasion we had, supervisors acting so fast. I think that at the level of the governments, we have to say that they also reacted very fast. I can mention, the loan guarantee schemes in Spain, but basically in all of Europe, these loan guarantee schemes were put in place very fast. We have, 100 billion euros in our case, which is not meaningless. And 80 billion have been put in place to be used by the banks with the clients. So we can say that the reaction has been very fast. At the EU level, as usual, at the EU level, the political level, if you want, not some technical level, but more political. Well, it has taken some time. That we have had some interesting debates among, member states. But at the same time, this morning, we have this package of 750 billion euros being put in place with 500 billion of grants. This is very powerful. So with different speeds, I would say, fastest of them all were central banks and supervisors and regulators, financial regulators, and then a little bit member states were the second line, and then at the European level we are getting something that is meaningful and is going to make a difference. That's my feeling right now.
Thank you, Jose Maria. I'm going to go next to Veronique, and I think we have her on the phone. And Veronique, you represent BNP, who is a leading bank active all over the world. So from that perspective of an internationally active bank, could you tell us how consistent globally you assess the regulatory response, and has it been effective in allowing banks to continue lending and financing the economy, and whether there are any challenges in the way for banks to continue precisely that lending and support activity?
Thank you, Andres. And sorry that apparently my video didn't work, but I hope you can hear me clearly enough. First of all, I can only support what has been said by Sean Berrigan and Jose Maria Roldan. Definitely, the response has been extremely determined and prompt, even if maybe a little bit slower than in other jurisdictions, given the structure of the European construct. But definitely, there has been extremely good dialogue between the regulators, the supervisors, and the banks, and that's extremely important and welcome. And I guess I hope that Sean will confirm that we are very happy to work hand in hand, I would say, with the public authorities, whether European or national level, to play our role in minimizing the social and economic consequences of this COVID. Has it worked? Well, just look at the numbers, and the answer is yes. It's a bit early probably to have combined numbers at the European level, but if we take the case of France, out of the 300 billion euro of state-guaranteed loans package that has been put in place, the French banks have already received client requests for 100 billion euros, which is a huge amount. And that represents around 500,000 different corporates with whom we've been collectively with the other French banks sitting down, trying to understand their needs, their liquidity needs, and trying to find solutions and putting at work the support program put in place by the French government. And the same is happening at every bank in every country in Europe and worldwide. And definitely this is a very, very important undertaking, and we are totally aware of our role. I think it goes beyond maybe what Sean Berrigan said in terms of our almost self-interest of making sure that we minimize the economic consequences, but it's just the DNA of the banks to be supporting their clients, not only in good times, but also in bad times. So definitely, I think whatever can be made is made. Efforts are huge. We commit to deliver loans in 5 days, which is, for corporate clients, something which is not at all usual. And we very much welcome the regulatory relief that comes together, if you like, with those support measures. I think it was very well thought, and it is certainly very efficient. Now, of course, there is a but, otherwise the panel would be already finished, right? So let me play a little bit of the devil's advocate for 1 second, if you allow me. What maybe is not fully working, or maybe working better in terms of the measures that have been already put in place, is actually maybe 4 things. The first point is, and all those relate to really technical implementation. I'm not going to get into the details, but just give you a sense of the reality on the regulatory front where we sit now. First of all, is regulatory uncertainty. Of course, we welcome very much all the statements that have been issued by the ECB, the EBA, the Commission. The interpretative statement that Sean Berrigan referred to was helpful, but every statement leads to another statement. So the statement leads to a guidelines, and the guidelines lead to an approval process, and the approval process leads to a lot of discussions and so on and so forth. So as always in regulation, the devil is in the details. And the fact of the matter is that today, as we are reaching the end of May, so 1 month ahead of the next quarter close, we still do not have the approval for the moratoria, the general moratoria. And I think it's not just France, I think it's most countries in Europe. So I think that the complexity of the implementation could have been streamlined, and because clearly we are in the process day after day, as I said, to put huge amount of loans on our balance sheet, and the way they will be treated from a moratoria standpoint, from a state guarantee standpoint, is still totally unclear to us. So we bet it's going to work, but it's a very uncomfortable situation to be in, and we would welcome, obviously, prompt responses on this. The second point is fragmentation. As you were saying, Andres, it's very understandable that very early on in the crisis, given the split of responsibilities between the European authorities and the national authorities, the first two decisions were basically provide more flexibility on state aid, provide more flexibility on fiscal deficits. And the two were absolutely critical, but then it was also a signal to send the ball, if you like, in the camp of the member states for them to implement the support program, which they did. But no surprise that each country did it slightly differently based on their law, based on the depth of their health crisis, and so on and so forth. So now we, as a bank operating in many countries in Europe, we are facing all sorts of different moratoria, all sorts of different state guaranteed schemes, and this fragmentation creates a lot of technical burden and also regulatory uncertainty, in the sense that many state guarantees may not be recognized as providing relief in terms of risk-weighted assets. And so again, we are unable to project our capital needs even by the end of June, given this uncertainty that is going on. And we would hope that as the Commission has mandated the EBA to provide some guidelines on state guarantees, we would really urge the EBA to interpret the CRM text, which we know is extremely rigid, but maybe in a little bit more flexible way, to recreate some form of level playing field across Europe, because it would be extremely problematic if at the end of the day, some countries' banks and ultimately clients are not recognized for the value of the state guarantees, whereas others are, whether some countries may be recognized of the leverage exposure relief and others are not, and so on and so forth. So I think that there are significant consequences over time of this fragmentation, and I would really welcome some realignment, I would say, in a second phase by the Commission and the EBA. The third point is the famous question of, is it enough relief or not enough relief? I think I would raise the question in a slightly different way. There is a lot of relief concentrated on one dimension of the regulatory framework, which is the risk-based capital. And indeed, this is the core of the regulatory framework, the CET1 ratio, and certainly this relief is very welcome. How much relief do we get? There are several figures. I think in the most recent EBA first update on COVID, they came up with a range of the equivalent of 600 to 1.3 trillion of potential lending made available by the overall relief, which is obviously very sizable. However, these amounts will only materialize if the relief is also applied to other legs of the regulatory framework, other constraints. Banks are managing their capital in a multiple of metrics. One is the risk-based capital, but we also have the leverage exposure. We also have the MREL constraints. We also have the GSIB scoring constraints. We have multiple constraints. And so the capacity of banks to enact those massive amounts that are being requested by the government, and rightly so, is only going to be as much as the dimension of risk on which there will be the least relief. So if the relief is not balanced between those various axes, we will not be able to put at work all the relief that has been provided on the risk-based capital side. And so on the leverage...
Yeah, I was going to say that's quite a lot in terms of the other factors that you are mentioning. And I can see that John wants to comment on some of the issues that you're raising. And I wanted also to ask him, so far it's not a credit crisis, but obviously we know that with the deterioration of the economy, that's the next phase. So I wanted to allow John to comment on what you were saying, Veronique, but also from the perspective of credit deterioration and solvency and financial stability issues. What's your current thinking of what's next, what's yet to come in the next few months? John, over to you.
Okay, I mean, maybe I'll link both my response to Veronique and your question as well. I mean, I think what we're trying to do here is to learn the lessons of the COVID crisis without forgetting the lessons of 2008, 2009. So, of course, we have to respond to the current crisis, an unprecedented crisis. But what we want to try to do is to respond in a way that doesn't fundamentally undermine the objectives of the framework. Because actually, the reason why we can say things like the banks are part of the solution and not part of the problem this time is because of what we did over the last 10 years. This framework made sure that banks entered the crisis in a much stronger position than they were in 2008-9. So we don't want to sacrifice that while trying to employ the strategy of getting liquidity into the economy. So that's the first, my reply to her. We are in a continuous dialogue, as Veronique said. We're trying to work out what is that balance in that dialogue. But that balance has to be found, because there is no point in responding to this crisis and then fundamentally undermining the resilience of the banking system in doing it. And that's particularly important when you look forward, because as you rightly mentioned, there will be a second phase to this crisis, which is the sort of repair phase, the recovery phase. And that phase, just as this one has been characterized by acute liquidity issues, cash flow problems for companies, the next phase is going to be characterized, I think, more by solvency. Now, we know certainly in Europe, but I think also in other parts of the world, the corporate sector has entered the crisis very highly leveraged and will exit this phase of the crisis even more highly leveraged. Now, you can argue, and some are, that we are even now in a more low for long-term environment, so a low for longer environment. But two things. One, I think the spreads around the benchmarks will be different in this phase. Okay, so there will be more discrimination around the benchmarks. So I don't think the conditions will be quite as favorable for debt servicing. And of course, leverage levels will be even higher again. So I think there is going to be an issue around solvency, which means we now enter this new word we have, a phase of re-equitization of the economy, and where the focus will have to be more on equity and less on debt. And you'll have seen that in the proposal that the Commission made today, there is a large component of solvency equity, and that reflects that fact that we don't think that you can have a robust recovery by just piling more debt into the system. We now have to underpin the debt already in the system with more capital, more equity capital in particular, but also we can use hybrid instruments, etc. But more equity as a basis. And for that, of course, to the extent that we need to do that, this is also, of course, an issue for the banks, because the bank's clients will be the ones in need of solvency support. So it will be important for us as officials to address this solvency crisis as far as possible, so that we minimize the second round effects for banks, which of course will be insolvencies of their clients and the arrival of more non-performing loans on their balance sheets. And we need banks to retain, a sufficient degree of resilience to be able to handle whatever is the residual amount of insolvencies that come after the official action. We will do what we can to inject equity into the economy. We will do what we can to protect solvency. You will see around Europe there are already some pretty dramatic measures being taken to protect solvency. But I think we will not eliminate all the risk. And so it is quite likely that banks are going to face higher non-performing loans in this coming 18-month, 2-year period. And so they need to retain some minimum extent of resilience to respond to that. This balance right between of maximizing lending while still retaining, an adequate level of resilience in the banking system to face what is an unprecedentedly deep recession and a probably more gradual recovery than we had expected.
And Jose Maria, let me go to you. With that environment that John is describing, you can also infer, most likely very low levels of profitability in the European banking industry, cost structure that might continue to put pressures, and overall economic circumstances that are going to make the future very challenging. How do you think that the banking sector in Europe is facing those challenges, and how will it react to those conditions?
I think that the reality is what it is. I mean, I have to present the result of the Spanish banks for 2019. They were getting better, but we thought that there was still room for improvement. And now we are faced with 2020, the COVID crisis. And it's obvious that the challenge is going to be far bigger in 2020 than we have ever imagined. That's a reality. It's the impact of the crisis, it's the indirect impact on low interest rate environment. But at the same time, I think that there are also, some silver linings. For instance, the digital revolution that banks have embarked on has allowed us to be, fully operational, no problems whatsoever, neither in Spain or in any other European countries. Imagine that on top of what we are having, if we have had, some operational issues with the banks are working 100% perfect in this environment. And I think that's a value added, and this comes from digital. Going forward, what I would say that you need to do is very clearly, focus on increasing efficiency, focus on digital, and of course, on the side of regulation, we have to be realistic. I mean, if you release all these buffers just to tell the banks in 1 year from now that they have to rebuild them, we are going to have a second round, of credit crunch. Having avoided the first round, we will have a second round of credit crunch. So it's extremely important that the regulators deliver this message of certainty about, the rebuild of those buffers, through a process that has to be reasonable and commensurate to the difficulties that we are going to see. I think that in the end, banks, they are going to face challenges, but at the same time, we are demonstrating how useful we are in this current moment. I see few set of banks extending credit right now. I see a lot of banks extending credit right now. And we have to play a role in the economy, in the European economy in particular, which is an SME-based economy. And going forward, what we need is to be reasonable in looking for strengthening the banks back to where we were at the beginning of this year, but at the same time being reasonable on the time frames when you can do this. And cost efficiency is going to be of the utmost importance going forward.
Great, Jose Maria. Then using some of the issues that you just mentioned, and also going back to those factors that Veronique was describing. Veronique, let me ask you about those fundamental changes that are happening for banks in Europe. Balance sheet inflation, a substantial increase on sovereign assets, holdings, a likely increase on NPLs. All those, what kind of implications do you think they have for regulatory policy in Europe?
Thank you, Andres. I'd like to come back on the second phase that Sean Berrigan was introducing, and just to confirm that we totally share this view as most analysts that we will be facing at the end of this, I would say, urgency phase. We will be facing another wave of considerable challenges when the moratoria will come to an end, when the state-guaranteed loans will have to be converted into loans, and so on and so forth. And the root of the problem will be indeed the very high level of leverage in the corporate balance sheets and the sustainability of that debt. So clearly, this point of re-equitization is absolutely central. We very much welcome that it has been well flagged. and that it is starting to be implemented. I think there is indeed a role for Europe as a whole, for the development banks. Certainly EIB, EIF will play a major role. Of course, the development banks in the various countries, like KfW in Germany, and of course then the private sector. So I think orchestrating the way that the private sector can play a role in this is going to be an extremely important chapter, I would say, in getting prepared to the challenges that are ahead of us. And when I say ahead of us, it's probably going to start as early as September, probably, when the first 6 months moratoria will come to an end. So re-equitization definitely is a very, very important theme. The second theme is that, unfortunately, despite all these efforts, indeed, there will be a portion of our corporate portfolio which is not going to make it. And we start to see that happening in France and in other countries with, plans for job cuts and plans for closures or bankruptcies in various sectors that were maybe a little bit weak before the crisis and are getting the final hit with this COVID crisis. The cash flows are not going to come back immediately. Behaviors of clients will change and so on and so forth. And so I think there is one aspect that needs to be discussed, I would say, with openness on both sides. It is the Npl Action Plan. I believe that the Npl Action Plan made sense or was designed in a totally different context. And whereas obviously it will continue over time to be the goal of the banks to have to minimize their NPLs, I think the time frame of the implementations, the time frame for putting pressure on NPL strategies, on NPL secondary sales, all these kind of things can be quite detrimental to, I would say, a softer way of addressing the situation and taking into account better the social aspects of it. I'm not sure that we should continue to put pressure on banks to sell portfolios of NPLs to private equity firms that are probably less equipped to understand the situation from the day-to-day relationship with the client. So that, I think, is something that we would welcome to reopen a discussion on. Again, not to undo, the whole thing. And I'm sorry if my first speech sound to Sean that I was asking for regulatory rollback. It's not the case, but just adapt to the new context and adapt maybe the time frames and some of the substance. On the digital revolution, definitely the things are moving fast. And certainly it will come with cost cutting. From that perspective, of course, the software relief that is in the quick fix is extremely welcome. Of course, there remains a lot of uncertainty about the RTS that is going to be produced by the EBA, but we cross our fingers and we expect the consultation to come pretty soon. So hopefully the digital move is going to be helped significantly by this change in the regulatory framework. One other point, Jose Maria mentioned the buffer usability. This was also very, very helpful clarification that buffers are there to cover losses or cover bad times. So that is extremely welcome. Now, I think the question is appearing now of whether the banks will be able to use this flexibility, and if not, why not, and what are the obstacles. So I don't have specific proposals on that part, but I think this is also an area where it would be really welcome that the dialogue starts between the banks and the authorities to understand, and also the other market participants, whether rating agencies, investors, and others, to understand that a requirement is a requirement and a buffer is a buffer, and a buffer is there to be used. So I would say the speeches have been very helpful, but I think the market may not have totally understood the change in tone, and indeed also more clarity on the rebuild of the buffers and the time frame. I believe Mr. Enria had in his recent interview said that he would give time to banks. So I think I think more clarity on how it works would be very useful. And again, this is not a surprise that, we are testing this MDA framework for the first time, right? So this is the first crisis where we have all this in place. So there's no mystery that everybody needs to get used to how it works and maybe adjust what needs to be adjusted.
So let me use the final 3 or 4 minutes that we have for this panel to ask for final comments. Sean, thinking sort of from a long-term perspective, some of the issues raised about procyclicality, maybe aspects of the current regulatory framework that are operating in a way that was not intended, the future of Basel III, which the Commission was working on its proposal before the COVID happened. Tell us, what do you see sort of longer term for financial services regulation?
Well, I will say 2 things. I mean, one is that typically an event of this magnitude leaves marks. So there will be lessons to be learned for sure. I think the bigger question is going to be how you regulate a system. Do you regulate a system that can tolerate the full spectrum of events, including this kind of once in history, perhaps, event that we're having now? So do you set the rules in that basis, in which case you're going to have very, very flexible rules because you have to take into account such a wide range of situations? Or do you do what we try to do now, which is to inbuild into the system flexibility, which can be used at the discretion of the supervisors? So we as legislators will build into a framework. We will build a framework for day-to-day management, but try to build into it discretion, which allows the supervisors more freedom. I think that's probably the way to go. So for me, it's not about fundamentally reworking the rule book, and I don't think Veronique was meaning that. But there are some who are sort of seeing opportunities to go back to another form of regulation. I think that's not going to work. But we will probably have to look at ways in which we have not so much escape clauses, but inbuilt flexibility that allows us to retain the framework for the day-to-day, but use it in a sort of discretionary, intelligent way. I suppose that probably means you go back to less detailed primary law and use secondary legislation more aggressively, which I am afraid is not necessarily the direction we're traveling in most jurisdictions. So I think that might be the way to do it, is to go back a little bit less detail. So you don't have to come forward with primary law changes to make these quick fixes, but there's more flexibility at the secondary level. But we'll have to see how the political level feel about that, because, as I said, after the last crisis, the direction was very much in the opposite direction.
Thank you, John. Veronique, 1 minute with final thoughts.
I think what Sean just said is absolutely crucial. We noted that in the first proposal by the Commission, there was actually a proposal to provide the Commission with more flexibility. Unfortunately, the Member State didn't seem to be willing to go for that. So we can only support that as much as we supported the review of ESAs and more powers to be given to the authorities, to the agencies, because indeed, I don't think that the level 1 text needs to be as prescriptive as it is currently on things like VAR multipliers and things of that kind. So yes, I think it would be a very, very significant step in the right direction. And as I said at the beginning, I think we are ready to work hand in hand with the authorities to find the right solutions as we move on from the first phase to the second and the third in the coming months.
And Jose Maria, wrap this panel with wise advice as always.
Well, I mean, let me be a little bit more aggressive. I think that it would be a pity if we do not use this natural experiment to conduct a review of the regulatory paradigm that we have given ourselves. What I'm thinking about, let me put examples. Procyclicality. One of the key areas is how things are working in terms of procyclicality. IFRS 9 has been surprisingly extremely procyclical in this environment, and it had to be a little bit changed to avoid the problems. Sean was referring to this also. Simplicity, complexity. Can we really do a regulation that is a little bit less complex than the one that we are giving ourselves relevance, whether we like it or not. For me, one of the surprises of this moment has been how irrelevant all the resolution rules are being. I thought it was one of the great novelties of the new regulatory paradigm, and so far it seems that it's not going to play a role in this crisis, for good reasons. I'm not criticizing that, but the relevance of regulation that we have approved is another area. And finally, arbitrage, between the banking sector and the shadow banking sector, the non-banking, non-insurance world. When things go bad, who is here delivering, loans to the economy? The banks. Nobody else is in the bad moment. So I think that we should also reflect on that arbitrage problem. So I think there's a good opportunity of reviewing the regulatory paradigm using this natural experiment that we have been offered.
Fantastic. Thank you so much, Jose Maria. And thank you all, John, Veronique, Jose Maria, for this great discussion today. Now to our audience, let me invite you to stay online and watch my colleague Clay Lowry, who's going to have a fascinating discussion with Jose Maria Campa, chairman of the EBA. Thank you so much.